Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an
اسمعوا لكل كلمة.
in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Copy paste,
We
يلا.
at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
سكر عرف سكروا اللابتوب يلا. برافو.
Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation, also show somewhat stronger growth. What should we infer from this notion that on average rates were this year, but inflation is higher? More tolerance for higher inflation?
اسمعوا السؤالات.
Less of a willingness to slow the economy to achieve that target?
Well, it doesn't mean that. What it means is that, we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down. And so...
When you, just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
We're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Hi, Chair Powell, Rachel.
سؤالات كتير مهمين اسمعوا.
You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is We'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, you know, if we ease too much or too soon, we could see inflation come back, and if we ease too late, we could do unnecessary harm to employment and you know, people's working lives. And so, you know, we do see the risks as two-sided. So it is consequential. We want to be careful. Unfortunately, with the economy growing, with the labor market strong, with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But you know, we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, you know, we wanted to be careful about that decision. And we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that you still need, or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
Just a question, is there even enough data for you to be able to?
We'll take, you know, things can happen during an intermeeting period. If you look back, unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Hi, Chris Reaver, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter-point higher rates projected in 2025, 2026. Can you speak about why might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question? I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. I mean, my instinct would be that rates will not go back down to the very low levels that we saw where all around the world there were long run rates that were...
Election year, guys. Hashtag election year. Hashtag election year. Hashtag election year.
There's tremendous uncertainty around that.
Great, and just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already or you mentioned it being 2.8 in February. I mean, that doesn't sound like much disinflation at all. So are you still confident, or the last press conference you sounded pretty optimistic you would get more confidence at the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. So say your last part of your question again.
Are you still optimistic that you'll get the confidence?
It is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year, and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment to Anne that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supporters are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can't have that if you have the continued supply side activity that we had last year with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean, we saw, you saw last year, very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Hi, Chair Powell. Neil Merwin with Akylles. How do you assess the state of financial conditions right now, and in particular, do you view the kind of easing financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying, we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what used to 0.5% inflation now. We've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve.
تذكروه هيدا.
Understanding Congress has
تذكروه.
oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate is for maximum employment and price stability and the other things that we do. And that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There's another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, the payment system, the things that we do.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than 1% before you begin cutting rates? Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissents, and so you respect thoughtful dissents very much. It's like you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed, just to understand that book. So I treat dissents with real respect as well.
Simon with The Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target. Unemployment 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. I don't know. We follow all the possible stories that are out there about there being cracks, but the overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects,
شو حكينا من يومين؟
things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings, and quits, and surveys of workers and businesses are always interesting on this. How easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You do see things like the low hiring rate, and people have made the argument that if layoffs were to increase, that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee thought it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing essentially is and we're not discussing all the many other balance sheet issues. We will discuss those in due course, but what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea, that's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress, and that can cause you to prematurely stop the process to avoid the stress, and then it would be very hard to restart, we think. So something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
Will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's not urgent right now. We want to get this decision made first, and then we can, when the time is right, come back to the other issues.
Hi, Victoria Guida with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle where we wound up in a short reserves situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates, those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops nearer at zero?
Well, I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
أكيد لأنه أنت عطيهم إياهم.
Chair Powell, Jean Young with M&I Market News.
ازيك؟
I wanted to ask also about the balance sheet. You said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up the process for deciding that sooner, or will you wait until we're close to the end?
So it's sort of ironic that by going slower, you can get farther. But that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Are they, right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these what's happening in money markets, in particular, a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point ultimately where you stop allowing the balance sheet to run off, but then from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks the reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand. And then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile. And we don't want to, again, find ourselves in a situation where there aren't reserves. We have to turn around and buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specific would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. That'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. We would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Thank you, Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying, yes, it's appropriate for us to be careful as we approach this question.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But I know you have said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of the CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. You know, it has applications in wholesale finance, in payment system. And so we need to serve the public. These issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and that we've secretly got a lab here where we've got one and we're just going to spring it on Congress at the right moment. We don't. I haven't at all in my own mind made a decision that I think this is something the U.S. should be doing. I just think it's something we need to understand. We do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important has that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do on the transparency front, and what might that look like?
I generally think this movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data. And so it all happens that way. And so there's been a march toward greater and greater transparency. And that certainly Chairman Bernanke advanced that, so Chairman Greenspan did, Chair Yellen did. And so we went from four press conferences a year to 8, so now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. There's a long list of things that we've done. I think nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that, in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal. And we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. I said that any number of times, so those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year, and what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing PCE, core PCE coming down by 10% every month, I mean, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data come in. We would, of course, love to get great inflation data. We got really good inflation data in the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy. And now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it. Thank you.
Welcome to Closing Bell. I'm Mike Santoli in for Scott Wapner. You have just been listening to Federal Reserve Chair Jay Powell, the Fed, keeping both interest rates and its outlook for potential cuts this year unchanged. The markets embracing that status quo. The S&P 500 lifting to a new intraday record high above 5,200. The prior intraday high around 5,189. Of course, any rise today is a new closing high.
أعلى شيء رسل.
Russell 2000 small caps outperforming up 1.6%. Now, Treasury yields relaxing a bit lower, but mostly on the short end as we sort of get a little more confidence that the Fed anticipates 3 quarter-point rate cuts perhaps by the end of this year. The 10-year moving less, so you see a little bit of re-steepening of the curve. Maybe that suggests that the more tolerance for some warmer inflation. But I would say, in general, Chair Powell talks about the balance of risks between employment and inflation roughly equal, but he's not particularly concerned about any of them. So let's get to Josh Brown. He is CEO of Ritholtz Wealth Management. Liz Young, SoFi head of investment strategy. Just to break this down a little bit, Josh, markets seem to take the absence of any hawkish surprise as a positive.
جوش عادة bearish, عادة negative. Josh.
The chair is unconcerned seemingly about the little bit of an uptick in inflation, and so therefore kind of game on.
Yeah, my big takeaway is really that they're going to slow the pace of balance sheet runoff, which I found, I guess, to be something unique. I also think
they're talking about it, but they haven't decided it. But it's definitely an indication.
I mean, slowing the pace of balance sheet runoff reminds me of when Henry Blodgett was posting all this stuff from Hussman. So somebody said, well, you're going to sell your stocks then if you're so bearish? He said, I'm going to stop reinvesting my dividends. Okay. All right, we got it. All right. So that's one thing. Here was the other one. This is a quote. The risk is two-sided. If we ease too much, we could see higher inflation. If we ease too little, we could risk damaging the economy. Okay, thanks. For those people who have not been paying attention to what the balancing act is, there it is. And quite frankly, nothing really seems to have changed to the point on either side of that balancing act to push the Fed. And really, I think we're enduring higher 10-year rates fairly well in the broader market, which is certainly not the purview of the Fed. What the 10-year does, they're paying attention. Yeah. Consider this, Mike. You've got 7 basis points in the last week. You got 41 basis points year to date. It's a fairly substantial move in the 10-year. Stocks are weathering that really well. Yeah. So today didn't really give you anything new on that front, and I think the balancing act has to continue.
That is true, although again, first of all, we always, Liz, should throw out the little bit of a disclaimer that a lot of times post-Fed moves are kind of like whipsaw one way, then the other way. Right now, it doesn't
you will know.
here. But, you know, if you look at the...
Now we listen,
the
then we
summary
talk
economic
metrics.
projections, which came out along with it, they keep the median of 3 anticipated quarter-point cuts by the end of this year. Some of the highs and lows changed in there, so there's a fewer deep doves and not as much, you know, in the middle. But I guess I would say is it also comes with a higher than anticipated GDP for the year and a slightly higher core PCE inflation. Now, Powell seemed to say, well, that's just kind of marking to market what we know for the first 2 months here. It's not projecting ahead. But I guess that's understandable. The market would take that as a net positive.
I think it is understandable that the market takes it as a positive, and we should, frankly. If you're looking at just the math of it, which had concerned me earlier in the year, the math of them projecting 1.4% GDP growth, and we were still supposed to somehow generate double-digit earnings growth, it just didn't make sense. So I think their projection to bring GDP growth up is a positive. Obviously, inflation a little higher, not as much of a positive, but not quite as concerning if everybody still thinks the labor market is going to be strong. People can spend and absorb that inflation if they're employed and they're confident in their wages staying steady. The thing that I think is interesting, they did lower the expected number of cuts in 2025. Now we're just kind of pushing out the worry into the future even further. So we came into the year thinking we were going to get 6 cuts. The market has completely weathered that storm, brought it down to 3, and been quite resilient throughout, but lowered what we think might happen in 25.
Rate-sensitive stocks, though, are moving. And I found this really interesting. The ARC names, well, the ARC ETF itself is up 3%. Metals and mining up 2%. The regional banks are up 2%. Like these jumped out at me. And then I think if you look at the Russell 2000 on the whole, so you're up 2%. If you finish the day where we are right now, it's the second best day of the year for that index. So those things were interesting. Also should not be glossed over. While Chair Powell was speaking, we printed a new all-time record high in the S&P 500 above 5,200.
Yeah, the Russell doing that with its biggest holding, Supermicro Computer, down 3.4%. There was also in those projections a slight rise in the long-term projected neutral interest rate. Right? This is a theoretical thing. It's 2.5%. Now it's 2.6. But what it suggests is that maybe the economic potential growth rate is better than we thought, or maybe we have a little more of a tendency toward inflation than we thought. And there's a slightly less room between where rates are now and the neutral rate to say that, oh, they have a lot to cut before they get, you know, less restrictive. Now, again, this is all on paper. This is happening in the lab, so to speak. And previously, Powell had said, well, we only know the neutral rate by its works. You know, it's this concept we don't have to worry about. Nonetheless, it fits in with this idea that we have to at least acknowledge the economy's been performing better than a lot of the models would have suggested by now.
I think one of the points that he made, I don't know the exact quote, but something along the lines of, yeah, the neutral rate is higher than maybe we originally expected, but what we were used to pre-pandemic was abnormally low. Almost an admission that that was maybe a mistake, keeping it that low for that long. So get used to what would be more normal or what would suggest a healthier economy, actually, which is a higher neutral rate. And frankly, this whole higher for longer argument is not new. We've all been talking about that for a long time. So now their data, their projections is just showing us that they too expect it to be higher for longer. It's just a matter of, is it too high for the economy to be able to refinance the corporate maturity wall that'll start heating up in 25 and 26? Is it too high for the cost of funds? When will the yield curve get back to normal? Those are still the unanswered questions. But today's statement, as much as I want it to be dramatic so that we have more to say, wasn't that dramatic.
No, I mean, it's sort of dialing ahead by 3 months of more or less what they said in December. It gives them less time to get to those 3 cuts if they're going to get them in this year. Again, you can't always take that as gospel. CNBC senior economics reporter Steve Leisman, just stepping out at Chair Powell's news conference, joins us now. Steve, I know you asked him about, you know, the interplay between the expectation for potential easier policy and the projections for inflation and growth as well.
Yeah, let me tell you behind the question I asked, which is that they raised the inflation forecast, they raised the growth forecast, they lowered the unemployment forecast, and yet they didn't do much change this year to the outlook for the funds rate. So you could come to a bunch of conclusions of that. One conclusion I asked him about was, hey, does that mean you're more tolerant with higher inflation, less willing to you really clamp down on the economy? Do you not feel it's worth it to really slow the economy more than you're going to get the inflation results that you want? Now, he kind of slammed the door on that and said, no, that is not the case. So here's what he said.
We're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time.
So, Mike, this whole debate may not matter, because if we do resume the downward
كسرنا 39 حوة.
then the Fed's going to be in a good
39,500.
in a couple months, if these
أنا راح
sort of
أظهر.
lousy inflation or not improving inflation numbers continue, then what does the Fed
Target.
do? Does it decide, you know what, we can't tolerate higher growth the way we've been tolerating it?
حطيت
We
my
need to
TP
make
أنا.
faster progress on inflation. So it's not a question for now. It's one possible, what would you say, inference you could take from the data, but it's not definitive.
Right, and we do want to mention we continue to make further new highs in the S&P 500, as well as the Dow rising about 1% now as well. And Steve, you know, it's sort of interesting because Powell sort of declined a couple of opportunities to declare a little bit of a harder line on inflation. He conveyed a fair amount of tolerance of what the January and February inflation numbers have.
NVIDIA صرنا فوق
indicated,
900.
you know, some confidence that it'll go lower and emphasizing the progress made over the course of the past year.
Mike, I think you're hearing exactly what I heard. There were several opportunities for him to come in, and those would have been, by the way, opportunities for him to sort of bolster his inflation-fighting credibility or his concern with it. He did say, hey, if it keeps up, we may stay higher for longer. I think that this also, by the way, this discussion tells you that the Fed and the Fed Chair Powell believe there's quite a bit of restraint in the current rate. And you look at the fact that they did raise the news rate by 2.6. Well, what does that mean? It means they're still quite a bit above at 540 or so where they are right now, where relative to the news rate. So they believe there's plenty of restraint in the system, which I guess suggests they feel there's some upward or bound that they could go, or some tolerance they could have for higher inflation, and still feel like they're addressing it with a restrictive funds rate.
Right. Steve, stay here. I do want to bring in Josh and Liz back into the conversation. So, you know, in some respects, and I've been saying this for a while, this hasn't really been a Fed-driven market. It's kind of a market that wants the Fed to kind of be in this predictable spot, somewhat out of the way, Josh.
Well, here's what's different, the first half of 2024 versus the first half of 2023. In the first half of 23, we had serious acute issues with banks right around now. And we also had a scenario where inflation was outpacing wage gains. And that was a very ugly place for a lot of people to feel comfortable. This is the opposite. Yes, it's true, inflation is somewhat sticky. What's also true, the cause of the inflation is the fact that people are doing really well right now. And actually, wage gains have started to outpace the growth in price gains throughout the economy. So people don't feel it yet. You don't hear a lot of optimism, but it is the reality on the ground, and the Fed understands this. And so as a result, they're not in a situation where they have an emergency on either side of what they're doing. Last year, again, remember, inflation way too high, plus the risk of, if you kept hiking rates, you might blow up the banking system. Both of those threats seem to have been neutralized. And so to your point, Mike, we are in this place, we're in a little bit of a box, but no emergency on the left, no emergency on the right. And so I think as a result, everybody has the benefit to move more slowly and make decisions at a lesser pace.
Yeah, and of course, history does say that if there is going to be an easing cycle, a slow and measured one is usually better.
الايكوال probability قد ايه قليلة. هون بنطلع بجون. بعد عنا 5. لازم نعمل 3 ريت كوتس من ب5.
From the Fed or anything else, and it's one of these situations where it seems like the market kind of keeps discounting the same pretty good news every day, or some version of it. Now, it's hard for valuations to really start to bite, even if they're high, if the Fed is going to be, you know, accommodative, and if earnings are going higher. But I guess, how would you think about the overall market field position at this point?
I think the market is queuing off of some good things and then some momentum and a lot of risk appetite that people just really want things to continue moving upwards. So that's where you've seen this big rotation, maybe out of the stuff that was very obviously overvalued, very obviously crowded trades, and into some of the things that are still risk assets, but more cyclical, more attractive. We can sleep at night paying that much for that particular part of the market. And I think that's healthy risk appetite in this part of the cycle. I still think there's a pretty strong debate between whether or not we're late cycle or mid cycle, and if the Fed doesn't land this plane or doesn't stick the landing, we could accelerate into late cycle pretty quickly, overheat again, and that's the big question. But so far, it's working, and the broadening out today especially.
ليكو الراسل
Might be better if we never get the
ليكو
first
ما شفتوه انتو 2.15%.
this thing that's on the fishing line out in front of us, and asymptotically we just continue to move along and wait for the
27 minutes to close, يلا.
and it really never even has to come.
I would say indefinite, if not never. But yeah, I mean, Steve, what are we now, do you think, going to start to look toward, right? We're getting some more Fed speak. I guess we're going to have the February PCE report. Is it the end of this month or so?
Well, Mike, if you know what, I want to expand on what Josh said, which I think was really interesting. Guys, if you listen to the press conference, there wasn't something that folks were able to hammer Powell over the head with, to say, how could you possibly not be cutting rates given that this thing is happening? Josh was right. We've moved away from the banking crisis of last year, which was an obvious thing. I can't point to something to say, you idiot, why aren't you cutting rates? That question, that pretense does not exist. Now, maybe missing something right here. It could be the CRE thing. It could be something going on in the banking system. But right now, I'm looking, obviously, to see, Mike, to answer your question, does consumer spending hold up? Does the delinquencies that we saw, it looked like they stabilized into last year, do they remain stable? Are there systemic risk issues we'd have to worry about? Are they going too far with the balance sheet in terms of reducing it by too much? And does the sort of cumulative effect of higher rates have some impact that was just delayed and it's coming? But I think what Josh said, it should be expanded. There is not the thing out there that you say to Powell, how could you be missing this and why aren't you cutting right now?
Well, that's very clear, Steve. I think that's well said. On the other hand, you would almost imagine a scenario where you could pound him and say, how could you not be taking a projected rate cut out, right? We had these higher than expected inflation numbers, and the economy needs nothing. Yeah, exactly. And so, I mean, it's sort of like when he was asked, oh, you still are anticipating shelter inflation to kind of revert lower, and he's like, I think there's a lot of expectation it's going to happen. He wouldn't say when.
I think his answer is okay there, Mike, in the sense that, hey, we're very restricted. We got a lot of restraint in there, and we haven't taken it away yet, and we haven't promised you we're taking it away, which kind of leads to the thing I think Josh was just getting at when I kind of interrupted him. I'm sorry about that, which is, if it doesn't go, if the rate cuts don't happen, Josh, are you cool with that? Is that a signal for stocks?
I don't want one because I don't sell solar roof panels. I'm not a mortgage banker. I might feel differently if I owned a hotel chain. I might, seriously. But I'm not, and by the way, for the people screaming, they need to cut rates to support the economy because younger millennials need to buy a house. Well, what do you think is going to happen to the home price when mortgage rates come down 100 basis points? You think that's going to work in your favor?
Of course not.
Are you crazy?
Well, I also think nobody actually has a real firm idea of what happens to the 10-year yield, which mortgage rates are more based on, if in fact we're starting to cut right here. Liz, you focus on the yield curve. 10s aren't moving much at all. 30s aren't moving much at all. I'm not saying it's going to be the way it is, but it's not an automatic.
I think, Mike, that's a debate we haven't had, which is this whole scenario sets up higher for longer on the 10-year, which sets up for higher rates or more competition for stocks down the road. That's really an interesting debate to have, I think.
That's right. Well, and I think the other thing about that is the 10-year is also going to follow what inflation expectations do.
Sure.
And those have not moved much. So that's been working in the Fed's favor. Expectations have been reasonably anchored, except for at the 2-year portion, but they've been anchored over the long run, which gives them the flexibility.
23 minutes, guys.
We can wait. We've got the strength in the economy. We've got the time. if inflation expectations start to look more threatening, you're going to see the 10-year move pretty quickly.
Yeah, that is one of the many things we now have to turn to and watch in the next few weeks. Liz, Steve, thank you very much. Josh, seeing a little bit in the market zone. The S&P 500, as we mentioned, crossing above 5,200 for the first time, holding above that level. Joining us now is Sarah Malik, Chief Investment Officer at Nuveen. Sarah, it's great to see you. So we do have Fed basically more of the same in terms of its message. Same 3 anticipated rate cuts. Market seems fine with the Fed sort of stepping aside. What were the key things you would pull out to observe?
Yeah, it's great to see you. I think that there's 3 outcomes that the market's like.
شفتوا وين أخذنا التي بي فوق ال 500 وشكرا وشكرا وشكرا. مين البطل؟ مين البطل؟
Under the hood, let's first look at the dot plot. That is teetering on the brink of moving to just 2 rate cuts this year. I think that's where we likely could end up. And also with inflation, Powell sticking to his 2% target. The question is, when will we reach that? I think it could be years rather than months before we get to that 2% target. So second is, where does the market go from here? Well, first of all, there's a lot of FOMO, trillions of dollars of cash on the sidelines that's been looking for how to get back into this market. And I think secondarily, for the S&P to continue to move higher than 5,200, we need this rally to continue to broaden. That's where I'm more of a skeptic. Just looking at earnings growth for 2024, tech.
طبعا في أحلى من اللي نشتغله إحنا في أحلى.
The rest of the S&P about 5% earnings growth. This strong economy needs to translate to the rest of the non-tech S&P 500 to boost that earnings growth. I think that's how the market will sustainably broaden from
here. Russell 2000, baby.
That's going to kick in right away. Does that suggest the risk reward at this level for the market in general is not that great?
I mean, I think it's going to be tough to find that catalyst to have moved. If you look at the non-tech portion of the S&P 500, they are dealing with this sticky inflation. Wage inflation also is impacting their margins. Also, on the revenue growth side, they just don't have the structural tailwinds such as AI and the demand to increase productivity that's benefiting tech companies. The rest of the S&P doesn't have that. And you can see that in the material sector, energy sector, and healthcare sector, which are under pressure in terms of earnings growth. And those are large drivers of the rest of the S&P.
You know, you mentioned that certainly there are trillions of dollars in cash. You know, a fair portion of that is retail investors. But if you're an investor and you're involved at all in the equity markets, hasn't the market itself kind of kept you involved and raised your exposure and kind of allowed you to have both at once and have the cash cushion, a little bit of income, and then be able to, you know, support whatever equity risk you want to take?
I think we are hearing from our clients that many of them are rebalancing somewhat out of equities because of the huge run that it's had, and they're just trying to be disciplined in terms of diversification. I think a lot of that cash, when it comes back into the market, what it should be looking at is fixed income. High yield fixed income from taxable to munis, you can lock in yields in the high single digits, even sometimes in the double digits that you haven't seen in years. It should be a little bit more resilient because we still do expect 2 to 3 rate cuts this year. I think that's an area where you can get out of cash and out-earn the 5% that you can earn in cash and get more returns in fixed income.
And I guess, you know, raises the question about the rest of the world. You know, there has been global confirmation of this bull market. You've seen some strong markets elsewhere, but there's a lot of catch-up to be done. If you think that we need, so to speak, the market to broaden away from big cap U.S. tech here, that would also suggest the rest of the market, the world would be less disadvantaged.
Well, first looking at Europe, I think Europe is in the disadvantaged camp. They have a similar inflation problem, but they just don't have the economic growth that the U.S. has because the U.S. is exceptional when it comes to technology and its leadership. China, of course, maybe some green shoots there, but still property issues and other issues in terms of China getting back to its historical growth rate. Japan looks promising. Japan GDP growth, the consumer in Japan, I think Japan is an area that investors can look at. And just thinking about the world on a global basis this year, something else to consider since it's already March is that we're going to have 77 elections this year, 60% of GDP. Normally that does cause more volatility for the market. I think it's going to be a little bit more than noise this year because the less predictable the election outcomes are, the more volatile the markets are. So that'll be, and with the misinformation, with artificial intelligence, I think that could add volatility to the markets as we sit at 5,200 on the S&P.
Yeah, I mean, I know the historical patterns in election years absolutely say that's the case during or after the summer. You should expect a little bit of turbulence, but for now, the market seems pretty undisturbed by any of that. Within the U.S. market, then, are there spots you'd be able to pick outside of tech where you feel as if they're underappreciated, or is this market pretty well picked over?
Yeah, I think within tech, first of all, you need to be selective, but there are promising technology companies that are continuing to thrive in this kind of market. Amazon, which has invested heavily in its logistics, I think will continue to do well. Outside of technology, looking at laggard sectors like REITs, that's an underperforming sector this year as we unwound from 7 rate cuts expected to 2. REITs have lagged for a couple of years. They've kind of been the baby thrown out with the bathwater over all the real estate.
جايز يلا
If you look at
بعد نص ساعة بنفوت على تيك توك بنحكي. شوفكم على تيك توك بنعمل سمري يلا.
that we're in.